So welcome, Perennial Pride listeners. Thanks for joining me as always. Really hope you're getting some value out of this, and you're always trying to think of new ways to bring insights and education to you so you can actually benefit and use it in some way. So, we're changing it up a little bit this week. It was an idea from my assistant, Kira, to do a kind of different sort of format today. So we're going to give it a go. So Kira, appreciate you joining me on this episode.
Yeah, happy to be here. Excited to see where this conversation's going to go.
Yeah. It's funny because we always have conversations on side topics, and I know you've been such a great thought partner to help think through things. But, one of the things you recently brought up to me, you said, hey, why don't we talk about what's happening in this world today from a financial lens, economic lens, and, the topic, which I think is really intriguing. It hits home for me personally because of, as I think about the younger generation and challenges of people getting into homes. Well, our friends in the White House and Trump specifically is considering this 50-year mortgage, right? You didn't go from 30 to 40, it just jumped to 50 right off the bat, and what that may mean. And so today we're going to cover kind of, things about that, the good, bad, and ugly of it, and maybe touch on a little bit of history and where this even comes from. So, Kira, from your lens, maybe share your kind of initial reaction when you first heard about the 50-year mortgage or possibly.
So we obviously have had a couple side conversations that decided that we would have this podcast. When I saw the headline for the first time, I just kind of rolled my eyes at it. Part of it was from an uneducated opinion in the sense of 50 years is just ridiculous. Because if you think about it, but let's just say the average first-time home buyer, that age has now gone up. Whereas maybe back in the day, even 10 years ago, maybe that age was, 25, 28. But what if that first-time home buyer age is now up to 35, 38, and now you want to tap on a 50-year mortgage? Well, now you're 80 before you're even paying off your house. If you just pay your monthly payment, you don't make any extra principal payments, you don't take advantage of any refi opportunities, but you're just really putting yourself in debt even longer. And, I think that people probably view this as being a really good thing because they look at it from a 30,000 foot view. They look at it from, this shiny thing perspective. I think my favorite number is 200 for this example that we've talked about. So, let's say you're saving $200 a month on a payment between a 30-year mortgage to a 50-year mortgage. Well, I'd be willing to wager that a lot of Americans look at that and go, ooh, where can I go spend that $200?
Right.
They don't take it and go, you know what? This is an opportunity for me to crunch some numbers. Let me take that extra $200. Let me apply it to extra principal. Because if you're doing that, yes, your payment is lower, but you're also getting yourself out of that 50-year mortgage sooner. You're putting yourself in an opportunity to have less overall interest on your mortgage too. So I think that most people don't look at the whole picture. Do they look at the full amortization schedule at a 50-year mortgage versus a 30-year mortgage? I think we've just become a society that goes, they see the highlight reel. They see things on social media and they go, ooh, I have to have that. So when they see an opportunity to lower their payment, they're going to jump on it without fully educating themselves.
Yeah, no, it's a really big point. And I think there's we get so numb to, the concepts of mortgages and having a 30-year mortgage, which before we start recording, we talked about most countries don't even offer this fixed 30-year mortgage. Like Canada, they'll have 30 years, but it acts like an arm. It's like a 5-year fixed period, and then it adjusts because the banks would never do that because they can be at risk to have this massively long fixed rate with, interest rates changing over time. And inflation kind of peaking its ugly head. So it puts them at a precarious situation. And that's why most countries don't even, and banks don't offer it. Today, we'll kind of go deeper into it, just to give it the good, bad, and ugly sort of review. And we talked about there's not, anything that gets thrown out there, it's not all bad in terms of the first-time home buyer. The average age is now gotten closer to 40 years old.
Wow. Okay.
And it's quite amazing. And it's, I can feel it very acutely because I have a niece that's in her late 20s, and seeing the struggle she's having with finding an affordable home for her, it's crazy. Living with little to no debt, and it's still very difficult to find a home that's affordable. It could fit into a proper payment schedule that fits your budget, right? And imagine that for the rest of the country, maybe it's just, that's what's happening. And so that's, I guess, why these things get considered. How do we make it more affordable?
Well, and also, taking into account too, the other thing is, I guess five years ago, I was in a different home and my interest was 3.18. So in the last, that's the other thing is think about how much more affordable homes were 5 years, even in the COVID surge or post-COVID surge of the housing market, where it became a seller's market, right? It was, you were willing to name your firstborn after the people who were selling the house because, you were so desperate to get into a house, and bidding wars and everything, like, and the interest rates were so low, but the house prices were higher. But now, over the course of 5 years, we just recently purchased a new home 2 years ago, and the interest rate doubled. And we weren't even as high at that point as it actually got. Now, yes, they're slowly starting to come down, but a lot of people can afford the home price if you think about it, right? If you think about I don't want to say a normal situation with interest rate, but if you look at it from a more, I can't think of the word, normal is definitely not the right word for it, but approachable interest rate, between the highest that it was and the lows that it were, around COVID, it does make a housing price more affordable. But I also feel like what's making housing prices right now unaffordable to people like your niece are the interest rates. The interest is just absolutely killing people. And now by tacking 20 years onto the mortgage, that's more than half of a 30-year mortgage. You're tacking an additional, almost 1.5 times onto your mortgage. Think about what that interest is at 6% on a $500,000 house, on a $300,000 house. It's outrageous. And honestly, it's one of those things that a lot of people they can't afford.
Well, and that's, this is where when you distort markets, and again, it's amazing because if you look back history, like 6% mortgage rates is actually not that bad historically, but we got thrown into that mix. You and I also in the world, we're buying like these crazy low rates that just were artificially manufactured. And so, we get used to it though. We're like, oh, this is just normal. Well, it really isn't normal. What's normal is more like today, but it feels worse because we got so used to low interest rate environments. But that really, if you look historically, that didn't exist. And it's because of the way that the Federal Reserve and the governments were pumping more money into the world and guaranteeing so much that it created these sort of artificial environments to spur what we saw, purchasing like crazy, and it led to a lot of crashes. So it's one of those weird things when you really reflect on it. 6% feels awful when you can get a 3%, but that 3% was just kind of a weird situation. It's not a normal cycle. It kind of created. And so, now the governments who created it are trying to fix it.
My thought goes to 2 questions for you. One might put you on the spot because you mentioned something about a crash. So my first question for you is, do you think that potentially runs the risk of crashing or just having a negative impact down the line in some way, shape, or form? So that's question number 1. So I'll let you answer that before I go to question 2.
Yeah, I think it definitely opened the door for that. So when I think about it, I think in 2 ways. One, and you hit it on the nail earlier in this conversation, that we get so enamored with the payment amount. We may forget about, like, are we buying a very overpriced asset? Because the loan is going to be large. You're not going to pay down the interest very fast. So you might be in a situation where people are buying properties and assets that are way above where they should. And if there is corrections in the economy, job market, you see it already, you might be in a position that you not in the not so distant future, your asset actually may be worth less than the loan. And that's exactly the stuff that happened in 2020, like leading up to the housing crisis, because they were allowing these things. They were just pumping out loans like crazy. And the banks were just like, it was just like a printing machine of loans, even for people who didn't have incomes. Like, it's just kind of thinking about that is insane, right? You have no income, but I'll give you a loan for a massive asset, right? So that's a big risk in my mind if people are not taking the time to say, is this home within my range? Is it appropriately priced? Because if you're just thinking about the price of the payment, then you might be missing out and putting yourself at risk that this loan is actually going to exceed your asset, and your asset could go down in value pretty quickly.
It's funny that you say that, because when we bought this house 2 years ago, interest rates what they were and the price of the house is what it was. Obviously, we pulled costs. We looked at the sales history of this particular house and what it sold for prior to the COVID surge. And it, me more so than my other half, but it was kind of one of those, oh crap, what happens if, we go into another recession and obviously housing prices go down and now we are upside down in this home that we have. But there were a couple things that we thought about when it came to that, is that one, this home we plan to be in, unless something unforeseen comes up that we obviously can't predict, like we plan to be in this home for a very long time. So for us, we also went, you know what, the housing market could do this in the span of 20, 30, 40 years that we're in this house. And there's no way of predicting that. There's just no prediction whatsoever of what the market is going to do, what the real estate market is going to do, any of that. So we kind of went, well, do we not buy a house? Do we not move on to something that we need, something bigger for our family, setting us up for when the kids are off in college and they want to bring home a bunch of their friends? And, we've got a house full of kids. Our long-term dream for us was worth the risk of what does the housing market do? But we also knew that it's unpredictable. So we couldn't not live our life based on unpredictability, if that makes sense.
Absolutely. I think you're thinking about it in a smart manner. I mean, buying a home is a big commitment. Obviously, you have a long loan payment, and some people are not in their homes for a long time. But I do think where it makes more sense is that you have a plan to be in the home for a longer period of time. I think that helps with this situation, especially when you're thinking about a 50-year mortgage, if you ever get to that road. I think really, if you are, like you said, thinking much longer term, obviously we still can't control everything around that. You may need to move for whatever reason, who knows? But at least the thought is that you are thinking longer term with it. You're going to wade through these things, and the payment itself is in your comfort zone for what you have today. Then I think it makes more sense in that respect. It could make sense for someone to take a 50-year mortgage because at least, again, we get into the numbers of it, and I don't think we're going to go deep into it, but it's still going to take forever for that to be getting into principal, right? Some significant principal, which we'll get into maybe the pros and cons of it down the road in this conversation. Yeah, if you're going to be there 10, 15 years, like you can wade through that, right? And you're smart and have some ample liquidity and other things elsewhere, because you're right. We can't predict it. We don't know what's going to happen. But as long as you have a longer term view of things, I think you can wade the storm and get through it.
And I think it's also too, I think two things are important. I think, there's a lot of things important, but for us, something that was really important was making sure that we also had a lender who was kind of in our court, right? They didn't just look at us as, oh, here's another mortgage I can find. This person has entrusted me with probably one of the largest purchases of their life. And so for us, we got a message from our lender that said, hey, good news. Rates are going down. We might be able to refi and get your payment lowered. So we knew that going in with the higher interest payment as well when we bought this house, that whenever we could, we would want to refi. We also gave ourselves the time frame of the ROI on the refi. If it cost us this amount of money to refi, we had to recoup that money in 6 months or less. That was our box of where we felt financially it would make sense. We got really lucky when our lender reached out and said, hey, we're at a point where we can refinance. Here's what's going on. And I think because the housing market maybe has slowed a little bit, I don't know if that has anything to do with it, out of my wheelhouse, education on that one, but they were offering full lender credits. So from a standpoint of a normal refi where you might be paying a lender fee or you might be paying some additional closing costs or something, all of that was covered by the lender. It cost us nothing to refi into a lesser payment. What we decided to do was to take the difference in what our payment is now and what our new payment was, and we take that money and we apply it towards extra principal every month. Because not only are we shortening the life of our loan, we're also shortening the overall interest on our loan too. When the time comes, let's say in 2 years from now, there's another opportunity to refi, then now we're taking even more money and applying it towards extra principal because we budgeted for the payment that we currently have. So that's another thing that I think some people, they don't think about doing. Again, it goes back to that shiny thing. Ooh, I can refi. Ooh, I can get an extra amount of money here. And they just, a mortgage is something that people just it's just on repeat, right? It somewhat set it and forget it. You don't really think about it.
No, you don't. And this is where we maybe get into sort of what's the good parts of doing something like that, reducing your interest payments, right? Giving you a little potential cushion down the road. If you need to sell it, you're going to have more equity in this home, right? It protects you in a lot of ways. And, but there's also, I've come across a lot of people, there's just a natural peace of mind. Like, so there's a lot of people who do not like debt, right? Just the feel of debt.
Yeah.
Right? I mean, and again, I'm not a physician trying to judge whether you shouldn't, but like, there are a lot of people with just the feeling of debt, and some of it comes from how they grew up, what they experienced, right? Maybe a bank took over their home, whatever the situation, but it kind of has a very emotional connection to their lives. And, to be beholden to a bank and they're going to seize this, like, I want to get that off my neck as fast as possible, right?
Yeah.
There's something to that outside the economic sort of elements to it. And for some people, that's the right fit, right? And they're building equity in their home, right? And they're going to reduce your interest costs over a long period of, shrink it, right? Mm-hmm. And God knows, like, people have ever get into retirement and other things, and thinking down that road, like, having a paid off home is a pretty good thing, right? Mm-hmm. To not have that burden in mortgage. Yeah, you have some taxes, insurance, whatever, but
right,
have the biggest piece of it off your books is pretty good.
Well, and then go back to that whole 50-year mortgage thing. And we talked about the average first-time home buyer at 40. So what's the average retirement age right now? What would you say that is? That most people are kind of retiring, whether or not they have a side hustle or they decide they want to go work in a garden shop because that's their hobby. Take that aside. But what is the average age people are retiring from corporate America?
I would say that it's definitely got to be in the mid-60s. I mean, somewhere in that range.
Okay, now that's 25 years. So you're halfway through your mortgage, which maybe at this point, you're slowly starting to flip on your principal and interest ratio for your mortgage, right? But you're retiring. Well, if you've got a higher interest payment and you've got a higher overall loan based on where housing prices are right now, how do you sustain another 25 years with a $2,500, $3,000 mortgage payment as you retire? I mean, do you have that amount of money in retirement that's working for you, that you can make that mortgage payment? Do you want to be 80 years old and making a $3,000 payment or, something around that, wherever it may be? I know that I'd rather take that money and go hop on a plane somewhere. Or if I have grandkids by that time, spoil my grandkids or whatever it may be. I don't want to be making a $3,000 mortgage payment at 55 years old or $2,500 or whatever people are paying.
Yeah. No, that makes sense. I know people probably live a lot freer without having that burden. That's why I think a lot of people use that approach leading up to retirement to extinguish that debt, just to kind of get it off their books. And it makes sense. I think the challenge for people who are getting into things like this is because you think of it. So we've clearly seen where there's some positive parts of this, right? To pay this down faster. Obviously, we're going kind of a little bit against the 50-year, like, how do I shrink it down? There's light interest payments. It could be a burden along the way, but for people, especially with lower interest rates, then they're hanging on for dear life. That's why they're not selling their properties. They have like a 3% interest rate. Well, economically, but even when they report these things, inflation is what, 3%-ish? You could easily argue it's way higher in reality, right? Mm-hmm. Inflation. And so, there's an argument to be said, okay, why would you having a piece of debt is almost like an asset, because that debt you owe is the money you pay back to that thing 10, 15, 20 years down the road is going to shrink in value so much over those years. I'd rather pay that later, right? Because what I'd pay $1 today, by the time I turn 65, it's going to be worth 50 cents. And that's what I'm paying these guys. I'll take my money and put it somewhere else and earn more, right? So that's a kind of different philosophy that some people take around these things to say, there's good things to have debt if you're comfortable with it, because you're making it the bank's problem that the value of our dollar is diminishing actually on purpose. Every year we live, right?
Yeah.
You have inflation. It's actually, they're targeting it to inflate so that our dollars are worth less every single day. Well, having a long amortization cycle and payment plan says by the time I get to 50 years, that thing's going to be worth 2 cents or something. It's nothing, right? And so you have these sort of angles to it. It says as long as you're deploying those dollars into something productive, investments, other things, that's potentially a different way to get ahead, right? And you're using the bank money. And, again, it's just a different methodology around it, but you got to make sure you know why that makes sense, right? And what are you going to do with that dollar? If you're just going to take that dollar and just spend it, well, that's not very good. That's not going to be helpful. But if you put it into productive things that can earn more and compound over long periods of time, unfortunately in the home, that money inside the equity inside a home actually has 0 rate of return. It does not grow, right? Your house value might, but the equity inside actually produces no rate of return, right? Outside, you have more flexibility. And so it's a balancing act, right? And that's why I don't argue against paying it down. Just know that you may not be able to get that asset for equity when you need it.
So I think it's a perfect segue into what my question number 2 was. Obviously, we've been working together for quite some time now. So, I know a lot about you and your business and stuff like that. So one of the things that you talk to people about, you've done other podcasts about, is real estate investment. So let's talk about a 50-year mortgage as it pertains to a real estate investment. With everything else that we've kind of touched on from the time we started until now, I just kind of want to hear your brain dump on that. I know that passive income and real estate investment is something that you do share, you do have a lot of experience in. So how do you think that 50-year mortgage is going to impact change?
It should be interesting. And that was one of my questions when I heard the 50-year mortgage idea. Who's going to be allowed to use it? Because when you think about it, and this is where we live today. And outside, and you made a very great point, you were pretty close without even, because you're smart, you just intuitively figure it out, like the first-time home buyer has gotten older now just because of the pricing. Well, what's also happened in this world is we're turning into a renter nation because most people can't easily get into homes. And so who's purchased a lot of homes? A lot of investors. Not only people like me, small-time investors, but institutional investors, people buying up tens of thousands of homes and renting them out. So that's where it becomes a question who this 50 years for, because, that's where in a lot of cases, I look at a 50-year mortgage possibility as more cash flow tool, because it can allow you to get into an asset and reduce the amount of cash flow you have to outlay every year to own it. That's really what it is, right? Just like you said, if I'm buying as a home, my primary resident, I can, for the same asset price, I can spill it over 50 years instead of 30, okay? So it allows me to not use as much cash flow. How does it relate to an investor? Well, that's why there could be a huge benefit for a cash flow investor. If you're an investor who's buying a property and renting it out for long periods of time, the thing that makes it productive is that you have positive cash flow. The rent you pull in is less than the mortgage, property taxes, insurance, all that stuff. And you get the profit from that outside of some other tax benefits like depreciation. We won't go into that. But in the simplest way, you have an asset that should have more income than expenses. If you can have a mortgage that is smaller, right, then it gives you more cushion for positive cash flow for rent. And if things work out with inflation and other things, rent will grow higher. But in long stretches of time, rent will grow. But now you have a fixed mortgage that actually doesn't go up. So hopefully over long periods of time, that growth in gap between income and expenses will grow. right? Over long periods of time. Obviously, we're in some weird cycles with things where insurance is really high and such. But theoretically, that's where you can win, where the rent continues to rise, even stays with inflation. Just use that as a simple sort of comparator. But you've got a fixed rate debt that is flat, right? And that's where you can win as a long-term investor. And that's why a lot of people who are in like these smaller properties like fixed rate, because it's guaranteed there. And then they hope that rent can continue to rise. And now you have a steady expense payment, right, that you have as your investment. So for investors, and that's why I'm curious to see if they even offer it and allow it for investors, because I'm pretty certain that a lot of them would take it if the interest rate is decent, because then they know what they're getting into from an expense level, and then they can sort of plan and see how cash flow can be created with rent.
So here's my next question, because we talked about the whole, your budget amount might be here, your payment might be here, but you're taking advantage of the gap between the two based on a 50-year mortgage. So from an investment standpoint, do you take any of the overpayment from your rent, your monthly rent, to your mortgage payment? And do you put extra principal towards that 50-year mortgage if you know that this is going to be a long-term investment property, right? Maybe it's something you just see the longevity in it. You don't see it, needing to be bulldozed due to regentrification, or you're in a good area of town, whatever the case may be. Do you make extra principal payments to, I guess, even widen your profit margin on a monthly basis? Because if you're making those extra principal payments, are you making your payment go down a little bit, but your rent payment is, like you said, staying or even continuing to grow with inflation?
Yeah. I mean, it's a good question. I think in a lot of cases, this is where it could vary definitely by someone's current situation, right? Because if you were in early stages of investing and you wanted to start growing this, the more money you shove back into the property, the less you have capital to deploy elsewhere.
True.
And so when you're in build mode, this is not for the faint of heart. You just got to be knowing what you're getting into in terms of an asset. But the beauty of real estate is that I can buy a property for, let's just call it 20% down and leverage 80%. Well, if I put all 100% in a property, there's only so much property I can own. If I take them and split into 5, I can own 5 properties with the same dollar, but using 80% of the money coming from somewhere else. So the more I shove in there, the less I can start planting seeds for the next property and expansion. And so for some people who are in growth mode, I think that's probably not going to be a prudent strategy if you intend on trying to grow and build more. For some folks, to your point, maybe they're a little bit more stable. They're looking for, they're not in massive growth mode. I'm just trying to limit the death aspect of it. And now I have a really high producing asset, right? That creates a lot of income. That's my main purpose, right? And I want to remove some of the cushion or risk around having a high debt on my assets, right? Some people take that strategy. And I think that could be a very smart thing. It keeps them safe and sound at night. They have a lot of cushion, right? They need to sell it. Great, right? Easy, right? It's an easy thing to sell and they still have money left over. So it can work in both ways. And it's just my problem with it is that then it may be hard to get that money if you really need it. So again, you just have to see kind of what your cash position is too, because every principal payment, it makes it difficult to get it. It's illiquid. And it's not a good or bad thing. It's just, well, actually in my mind, it's a bad thing. But for some people, it's actually a good thing, because if they didn't, they would maybe spend it or use it frivolously. At least I can settle back into an asset and it's preserving my wealth, right? And paying down my debts. So I wish there was one easy way to say it, but it depends. Early on, I would probably keeper. Later on, I could see the desire to pay it down. And maybe that's a good spot to put your money.
Yeah, absolutely. I mean, and again, I think it goes back to that whole 30,000 foot view thing where people they look at the highlight reel, the shiny new thing, I've got an extra $200 burning a hole in my pocket. And they just don't think about what is in their best financial interests. And I think that's just something that right now is just unfortunately kind of society as a whole. And I think that by bringing in this 50-year mortgage, again, more of an uneducated opinion, but I think that bringing in that 50-year mortgage just is not, my initial reaction is it's not going to help the financial situation that many people are in or the financial views that many people currently have.
Yeah, it's tricky. That's why I think on the side of it, thinking of who it might be good for, obviously, if you're in a really high price market, it's probably the only way to get in. Some of these markets are just so expensive. It's like no young person could get in. So it's potentially the only way to get in unless the prices of the assets come down dramatically. But if you're a new home buyer, I don't think this would be a good one to be in, but you're likely not going to be in this property anyway for very long for a lot of new home buyers. So being stuck in a fixed note for that long where you're paying little to no principal down, and in 3 to 5 years you're moving, you might have not moved the needle at all in the loan in that scenario.
Well, even, when we bought this house, we were fortunate to put down 20%. But even putting down 20%, the amount that we borrowed, which I think is still less than actually, I'm very confident that it's less than what the majority of people are borrowing. Even if you look at the split between our principal and our interest payment, it's still just, we were closing and we were with the real estate attorney, signing our life away on 100 different pages of documents, and I'm going through it and they're sharing and flipping and saying, oh, here's this. And, one of the last things we got to was the amortization schedule. And I, at that point, probably was like, nope, thanks, you can have the house back. Like, it just blew my mind. I was like, man, we worked so hard to put down 20%. And it's almost like at the time, what do we really have to show for it? Because interest rates were just high. And I think about people who only put down 10%, or maybe they, don't put any money down. And I don't even want to do the math on what that looked like because I feel bad for those people. Just to be completely transparent. That's just, I don't know how people can do it and just don't. I mean, you have car insurance, you have gas, you have other expenses. And, back to what we were talking about, debt. I don't necessarily like having the house debt, but I also understand that in my mind, the house debt is different than being in credit card debt because you make bad financial decisions. We don't have any other debt other than the roof over our head, but even still, I think about people who maybe aren't as fiscally responsible as I like to think that we are. And I look at what our budget looked like on a monthly basis, an annual basis, and things like that. And it's just how can we continue to go through this and have people afford? I mean, I live in Charlotte, right outside Charlotte, North Carolina. And I think at one point, Charlotte was one of the fastest growing cities. We were in a competition with places like Chicago for being some, like you were talking about how did you word it? Like more sought after, like high demand. Charlotte was in comparison with Chicago and like suburbs of Chicago. And we're a very new city compared to, even where you live or, Chicago or other places like that. But I am not exaggerating when I tell you every time I turn around or I'm driving somewhere, the number of apartment complexes that are popping up. They recently just built a whole development. It's not massive, but it's not super small. And it's mixed use, your normal apartments, but it's also people that everything is a for lease option of 3-bedroom townhouses. More people are renting than they are purchasing because why not? If you're going to pay $2,500 or whatever these are going for, but your mortgage is going to be more, why would you not rent at that point? Because you're not putting money into an investment or an asset, but on paper, you're paying less than if you had a mortgage.
I mean, this is where some of it, and there are some people like a Grant Cardone will never own a property as a primary resident. He has a very extreme philosophy on this. I want to put my money into assets, right? And in this situation, to your point, I can rent for cheaper than a mortgage you can easily understand the math. And then, obviously you don't own anything, you're not building any equity, but, I might be able to put my money elsewhere. I could buy a rental property separately that creates income for me and grows hopefully well. I do believe there is something to be said around building equity in a home, though. I do think there is some benefit to it. I think just for, Americans, at least for sure, there's something prideful in it and something, it's our home, our family. And, it isn't maybe the biggest investment we have, that's going to grow like crazy, but that ownership is important, I think. It means something. And so I don't discount that, even though I can talk all the economics, investments and all that kind of stuff. But when you put it in the situation you put it, yeah, there's no way that it makes any sense to put a mortgage on. If I can get a rent somewhere cheaper, why would I buy unless I just felt I needed to?
Yep. And you're probably getting even more bang for your buck at that point too.
Oh,
You're getting
yeah.
a brand new build potentially that you're moving into. Are you getting 3 bedrooms with 3 bathrooms? I'm sure that they're building places that are bigger in general because they know that this is happening. You've got a family, 2 adults, 2 kids. Well, you got a slam dunk. Each kid has their own bedroom, bathroom. You've got a bedroom, plenty of space. You're getting more bang for your buck in a new build lease situation. There are developments around here that are being built that are specifically for lease. The entire development of 100 homes is only for lease, for rent. They're not purchasable. You can't buy them. And that's becoming more common, with everything that now, that I guess only time will tell if that will subside, if the market goes down, the interest rate continue to fall, or, maybe even with this 50-year mortgage, if it, goes through, is that going to change? However.
Yeah. And listen, I don't know how accurate numbers are, but there is a massive shortage of housing in this country. It's huge. And that's what's driving a lot of people that kind of come together, will live together. And the cost is crazy. We'll see how that plays out. But like you said, you're seeing it now with the building of a lot of these other complexes because there is a need, right, for housing. And right now, there's the cost to build and put these together is pretty high. And so there isn't as much building going on. And then obviously interest rates are not helping the matter. And so there's less incentive to build. They can't make the money of it from it.
Right.
So now we're in a shortage, right? And that hopefully over time will get remedied. But, it is putting a lot of pressure on people to get into homes early because they think they're only going to go up, right? I mean, and we've seen it over long periods of time. It does go up because there's right now, there are some pockets in this country where, like Texas and Florida, there's actually pressure downward in pricing right now. But for most places, especially where I'm at, there's a shortage of people putting their houses on the market. Anything even goes out there, it's still getting multiple bids and offers. It's just the supply is so short. And so this is going to be another interesting dynamic. If you throw a 50-year in there, obviously, the likelihood is prices are going to continue to rise, right? That's going to be a downside to this. Pricing is going to go up because, to your point, you can make a lower payment and afford more.
I think only time is really going to tell who did. I mean, again, it goes back to the unpredictability of everything, and only time will tell what ends up happening in all facades of it.
Just quickly talk through too, and it's at one point I wanted to sort of make sure people understood, and I think there's a lot of people who get this. Obviously our government, I think they're in a lot of cases trying to do good things, but they sometimes get involved with things and it morphs the market if it were to operate independently from the government, right? A 30-year mortgage, if people don't understand, there's a reason most countries don't offer it and most banks don't offer it. And the only way they can offer it in America and push it is because the government basically will buy most of these loans from banks, or they'll guarantee them for banks. So it puts the risk off the bank, right? So how does this work in reality? Well, a bank can offer this, get you a loan, originate it, collect the fees associated, and then sell it to Freddie and Fannie Mac, their government entities. They just buy that loan and then package them into securities and sell them. And that's how the government can sort of spur that. banks in that scenario had no risk. They just process it, prove it, sell it. Now it's off their books and their risks are no longer there. So they can continue to do this forever if the government is willing to backstop it. And so the government has created this sort of environment to support it because they want people to be homeowners. So I get why they do it, but it's created a distorted market, and look what's happened. Like the pricing of housing is ballooned to a point where a normal family can't afford it. And that's what this is going to perpetuate, right? This 50-year mortgage. It's going to increase the pricing of it, and the government's going to be the one. And what happens if everything implodes? Who's going to be on the hook for it? Who do you think? We are.
I mean, we absolutely are.
We will be. The government shouldn't be. The taxes are going up. The debt's going to go. So, banks are actually out of the window. They're just going to process and make money. Looking at something like this, the comfort level, looking at it, why they do these things, and what kind of impact it has, because we already have a massive divide between the wealthy and the rest.
Yep. And
these things will make it worse, in my mind, because you're going to have asset prices even go higher. So, can it help people like investors? For sure. Broadly speaking, you do have to think about it from a perspective of how comfortable are you with the government getting involved with things like this? Because it is unfortunately causing some unintended consequences. And I hate to see it because I want people to have the opportunity to be able to get into the homes like this and live the American dream. But anyway, I'll get off my soapbox on that, but I want people to understand those sorts of things.
I think we could do a whole other podcast on the government involvement in our life when they shouldn't be involved in our
right. Involved with the education side of things.
Or women healthcare education.
Yeah. But, again, this gives you enough. So listen, I think the key takeaway for me from this is that, there's potential use cases where it makes sense and people would benefit from having a 50-year mortgage. There are cases. I think it probably is more of a cash flow management tool to shrink your payments and such. You get into assets you could potentially not get into. I don't think it's a wealth building tool unless you're an investor in business and real estate. But I think, it could help for those people who just couldn't afford to get in at a 30-year mortgage. It allows them a door to get in, right? If it's offered, right? I think that's a potential benefit. But you have to be smart about how you use it and when to use it. So anything from you, Kara, as we part from this episode?
No, I think all the stuff that we talked about offline prior to deciding to push record and do an episode about it, I feel like we covered maybe a little bit more PC in some of it. But yeah, no, I think it's a good perspective for people who are, who may go into it with a little bit of, like me, like I have an uneducated opinion about it, but I don't feel like my opinion is off base on, some of the way that I feel based on having a conversation with you and, with your expertise. So yeah, I think a lot of people just need to, time will tell a lot. And I think people just really need to sit down and focus on more than a 30,000-foot view of shiny things.
Absolutely. Absolutely. Well, we'll have more of these, but thanks, Kara, for entertaining my crazy thoughts around some of these things. And again, it's always good to learn from everyone. And even though you say you're uneducated, you're not. You experience these things. That's education. And your perspective is valuable because, everyone's coming at this from different angles. And I think having that perspective, is good for all involved. So I appreciate you spending some time and sharing your thoughts on it.
Awesome. Always happy to chat.
All right. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride Podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life. and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.